Hello everyone, welcome to the Grow Your Future podcast. I am Zar, the eggplant. And introducing my human calculator.
How you doing, eggplant?
Sam,
I'm good,
how are
eggplant.
you?
I'm fine, man. I think I'm back by...
Can you tell our listeners why I'm an eggplant?
It's the very lovely aubergine coloured shirt that you have. No, it's really nice, but...
It's the combination.
No, it looks good. It looks good. I wish I could pull off aubergine like you, man. Is that even a colour? I think it's a colour.
I think you just made that up.
Eggplant colour. Eggplant colour.
And you are the human calculator, which I want to touch on.
Yeah.
Have you always been good at maths? Did you enjoy it when you were a kid?
Yeah. I was never like a gun, so I didn't do like 4 units or super advanced maths. But
4 units was the top, right?
That was the top, yeah. I don't know what it's called now, but 4 unit was like the top. I was like 3 unit, dropped to 2 unit because it got too scientific. I didn't like the scientific sort of parabola bullshit where they're looking at all that kind of stuff, making graphs and all that stuff. Just about numbers, how they worked. I liked mucking around with them. And without even really seeing the importance of them for a future in that field, so I just sort of like numbers.
So from an early age,
yeah.
you were into it, and did you think that you were going to be an accountant, like quite early?
Don't know if it was an accountant. So I did a Bachelor of Management at uni with a major in accounting, just to have some financial sort of background in there. But one of my first mentors that we talked about on a podcast previously, that initial one, my brother's friend was doing a Bachelor of Commerce with major in accounting. So probably his influence on me and talking about balance sheets and stuff like that, reading books about accounting, that sort of made me going down that route. So yeah, I would say probably a mentor helped me go down that path.
That's awesome, because you're very good at it, right?
Oh, thank you, man.
Yeah, you're really good at it, and it definitely shows that you're passionate about it. Just like I'm passionate about being an eggplant.
Very passionate people, man. Very passionate people. Thank you for having me back, though. I was
Mate,
on last week, and I think from popular demand on Instagram, people wanted me back. Is that right?
Mate, no one wants to listen to me no more. Everyone's asking about Sam. So here he is.
Man.
So today we're going to talk about the rumble in the jungle in the property investment world.
In the property, and what do you mean by that?
Well, in the property investment space, there's always debates on what's better than the other. And I find it really, really odd because different things do different things. Different properties do different things for people, right? They're different vehicles. They achieve different outcomes. And outcomes aren't a generic thing.
Correct.
They have to match the individual.
Specific.
So there's always this debate, whether it's commercial property or residential, whether it's capital growth or cash flow. So what we're going to do today is we're going to go through these battles one by one, right? And give our thoughts on each one, and also come up with a verdict on who wins, right? Mm-hmm. Because there are so many narrow-minded people in this property investment space that spruik the one strategy. And it really, really pees me off, because one strategy might not work for the next person. And there's, like you always say, you famously say, Sam, there's a million ways to skin a cat.
True.
Right?
Yeah.
So let's dive into it. Number one, cash flow versus capital growth.
That's probably the most common one debated. I think when you're looking at property, they're the extremes, I guess. There is a medium, a happy medium, which we're able to identify if you have the right advisors in your corner. But most people, I guess, maybe from outside the property space, so maybe novice investors or people not in the game, they might think that they are one in itself separate. So you're either going to buy a capital growth property, usually negatively geared or something like that, or a property that provides good cash flow.
Sam, let's take it back a step.
Yes.
Capital growth is the appreciation of the asset, right? And cash flow is generally the rental income, the yield, right? Yeah. So anything above, say, 5, 6, 7% is a high cash flow asset. Whereas something yielding maybe 3 or 4% or even lower, but grows in capital growth, is more so a capital growth asset.
Correct, yeah. So that's how people more or less see the property market in one of those realms, and it's not necessarily so. From my opinion, what I see property as a great vehicle for is capital growth. But if you're able to get a capital growth property that has characteristics of a good yield, which we can identify, that's the sort of holy grail you're after. Because we're investing in property to get growth. You're not leveraging the bank's money to get a mad yield usually. You're trying to get a yield that covers the mortgage so you can hold a property and it grows in value. So in my sort of opinion, I would say they're both very important and probably on a balanced playing field.
Okay, so let's do the comparisons, right? You've got $50 positive cash flow from a high yielding investment, $50 a week, sorry. Or you can have, say, 25 grand a year in capital appreciation. I would always choose the capital appreciation, even if it's cost me $50 a week to hold on to that property, because an extra $50 a week in your portfolio is not going to really, I guess, pay for anything. It's $2.5 grand a year. However, you know, there are instances where people need a higher yielding investment to add to their servicing so they can get more loans further down the track. But that comes with assessment of their portfolio. So I think in the beginning, capital growth is probably the more important thing you should think of, and then think of the cash flow afterwards when you need to sort of add more assets to your portfolio. But it is possible to get capital growth and also cash flow in the same asset, right? It's hard, but it's possible. So for example, at the moment, we're getting assets that are producing a 5% rental return, but it's also producing a conservative 5 to 10% or conservative 5% capital growth return, which means that's double-digit growth, right? And you've got an asset in a blue chip location which is going to grow in value in terms of appreciate in value. Then you've also got that cash flow yield as well to uphold the asset. So the verdict for that is a draw.
I would agree. Yes, 100%. They're both needed and they're both important at different times. Capital initially and then cash flow maybe along the way.
Okay, let's move on. Number 2, principal and interest or versus interest only.
Okay, so we're talking about how to finance a property purchase or investment. So you have obviously the one side of things where you're paying down the loan. So this is investment debt, a good debt, not necessarily one you would want to pay down, or you don't need to if it's attached to a good asset. And so when you're going to make your repayments and it's affecting your cash flow, you're actually paying down a debt. Interest only is where you're not actually going to pay down the debt, you're just holding the debt and paying the interest on it. So it's a lot lighter on your cash flow and you can use that cash that would have been going to a loan for other things. So that's sort of what we're talking about with this one.
So interest only is like you're putting, like let's say for example, they come out with an interest only period of 5 years. So you've got a 30-year mortgage, right? And then you've got 5 years interest only, and then it normally reverts to say a 25-year principal and interest period. So basically for that first 5 years, all you're paying is the interest. So your mortgage is almost like on pause in terms of your debt. What I like about it is that it allows you to use that money that you were going to put towards the principal towards another deposit for another property. Now it gives you more, I guess, control over your funds rather than once you give it to the bank. Not that it's gone, but it's locked away. Like you can't access that.
Very hard to access.
I would rather all the control, right? So I think that's one benefit of interest only. Another benefit from interest only is that usually you pay maybe a slightly higher interest rate, but the interest is tax deductible.
Correct.
Right? Because we're investors here. We're not trying to pay down debt. We're trying to accumulate assets and we're trying to minimize tax. So most of our clients, they're in the accumulation phase. And when you're in the accumulation phase of trying to acquire assets, what you're trying to do is free up as much cash flow as possible. So you have that control so that you can tip that into more assets and just keep going and going and going. Now, there's going to be a time where you're going to want to pay down debt, right? And that's when you can revert to principal and interest. But that's after you've accumulated the assets.
Correct.
That's when you've finished the 10-year acquisition strategy. So I think, there's so many benefits with interest only, and so many people get turned off by, I guess, the interest rate difference, because everyone's so attracted to interest rates now, right?
Yep.
Now we're at sub 2%, so they see it, okay, well, the banks are offering me 2% on, say, a principal and interest, but a 2.3% interest only, which is actually quite close together. You might as well just go the interest only and have more control over your funds, correct?
Correct. I think a lot of people get mixed up when it comes to tax. So from my point of view, when I'm dealing with clients, I had one client thinking paying down the principal, he was going to get a tax deduction for it. You touched on it just before. Paying down the principal of a loan isn't a deduction. So it's not helping you with your tax return or your tax affairs. So if we're thinking from an investor's point of view, the interest only, you're spending money on an expense that you can claim fully back. So it's very efficient with your use of money. And we're talking more to investors here on this podcast. A P&I loan is like you're having your own home, right? So if I was to go and buy my home, it's going to be P&I, principal and interest. I have to pay down the mortgage. So if we're looking to, say, not necessarily avoid buying the home, but maybe later, I'd try and steer more towards an interest only, because if I get a P&I, it's like I have my own home. So I might as well not do that. Interest only, free up my cash to keep investing. So what would the verdict be on that one?
The verdict, I think, our listeners are going to be obviously say, guys, you're going to say interest only is the winner, right? And I just want to put a disclaimer out there. This is not financial advice.
Correct.
It's like the famous Peter Switzer would say, it's just brilliant financial education. So, obviously talk to your advisors and all of that sort of thing, because it's got to suit your situation. And I don't want to sound like we're being irresponsible with trying to hock you up with as much debt as possible. But we have spoken about this on a previous podcast, saying that, debt is now an asset. Whereas, 20, 30 years ago, paying down the debt, because debt's a liability, because your interest rate was so high, you need to do that P&I loan. But really, debt is now an asset. So if going the interest only allows you to acquire more debt, right? Because you've got more free cash flow. And when we say debt, we're saying good debt, productive debt. That's going to enable you to get ahead faster. So again, get advice on this, right? Everybody's different. Everyone's at a different stage. But generally speaking, interest only, hands down in my books.
One further disclaimer, this interest only sort of strategy, you have to be careful with the asset you choose, because you want something, touching on the previous point, that's going to grow, the capital growth is there. Because what you don't want to happen is, in 10 years' time, the property hasn't grown and your debt's the same amount as your purchase, you've gone nowhere. So that interest-only loan is allowing you to hold the property at a very low cost cash flow wise, but it's banking on capital growth. That's what you're doing it for. So the interest only, make sure, be savvy with that investment and make sure it's one that's going to yield a capital growth down the track.
And so there's no point in earning an extra $100, $200 a week in rent on top of, your repayments when the asset's not really going to grow over the long term.
Correct.
Like, that's where the real wealth is held, in the growth of the asset. So if you can have this thing called debt holding real estate in the highest growth markets and just have that cash flow supporting those interest repayments, 10, 20, 30 years time, you're going to be financially free.
Double, triple the value. Happy days.
Number 3, LMI, also known as lender's mortgage insurance, or a 20% deposit. Sam, can you just tell our listeners what lender's mortgage insurance actually is and who does it cover?
Lender's mortgage insurance is pretty much an insurance from the bank. So that what they're trying to do is they're charging you a sort of premium in case you can't repay the debt. So usually it occurs when you're borrowing more than, say, 80%. Was it more than 80%? More than 80%. Yeah. So in that case, the bank might look at you as maybe not that you're risky, but you're maybe a bit more riskier than someone else. So in that case, they're trying to just cover themselves, and they'll put a premium on your loan and that you have to pay. It's usually capitalized in the loan. And it's more or less saying that, if something bad is to happen, we've covered ourselves and we've charged you that insurance.
One thing that people get really confused on with LMI, they think because it says insurance, it's insuring themselves.
Yes.
But it's actually not. It's insuring the banks.
Yes.
Right? So if you default on a loan, then the bank is actually covered. You're actually not covered. So you're actually spending money on insurance for the bank.
Yeah. Right?
However, it really is the cost of doing business, because let's use an example, right? We've got $50,000 savings, right? And let's forget about entry costs and stamp duty and all of that sort of thing. But let's say we've got $50,000 in savings, which is a 10% deposit for a $500,000 property. Again, excuse the entry costs just for the purpose of the example. Now, for 500 grand, we could go, okay, well, let's save another $50,000 to come up with a 20% deposit. And that might take someone 2 or 3 years, right? But we could use LMI. Now, let's say LMI cost us, I don't know, what would it be on that?
$500,000 be between 5 and 10 grand maybe.
So let's just say 10 grand, right? It costs you 10 grand for LMI in order for you to get into the market today rather than 2 to 3 years' time. Now, the property prices today are going to be a much different story till 2 or 3 years' time.
Yes.
That $500,000 property today is probably going to be worth about 800 grand in 2 or 3 years' time, especially in the market we're in now. It's on fire.
Yes.
Right? So, for the cost of 10 grand, yes, you're insuring the bank. But wouldn't it make sense to get into the market sooner rather than later, right? Just so you can take advantage of that market exposure.
I see it as you're buying time. So you're fast tracking that savings, 50 grand, you're paying someone to sort of give it to you, that extra 10% deposit. It's all about time in the market, as we've talked about before. So it's trying to get in as early as you can. LMI is something you have to incur if you don't have enough money. It's just sort of the cost of doing business, as you like to say. What people should remember, a lot of people that don't use a tax accountant might not know this because they do it themselves. They want to save time, save money. LMI is actually tax deductible. So when you go to your accountant, you can provide that cost to him, 7 grand, 8 grand, and it's amortized in your tax return. So you're actually getting a tax deduction for it. So depending on your tax rate, to say 30%, that 10 grand is actually only costing you 7 because you're getting a refund on that expense. So LMI, cost of doing business, trying to get into the market maybe earlier than you can normally. But I think if you're able to get into a good asset, it's worth paying.
I think people get confused because they think that, okay, it's too risky. But I think it's risky if they choose the wrong asset.
Yes.
Like you said about with the interest only thing, right? Like you need to choose the right asset. Now, I think LMI works very early on in your portfolio. Eventually you want your LVRs, that's your loan to value ratio, to drop, right? So your equity position is a little bit more beefed up in your portfolio, but that's later on down the track, that might be at property 4, 5 and 6. So early on in the piece, I would recommend use LMI, like embrace it, like it's something that's there for a reason. They didn't introduce it just, to sting you. They've introduced it so it enables you to get into the market sooner. But do it under really good advice.
Yes.
Get the right asset. Make sure it's got some growth in it. Because what you want to do in 1, 2, 3 years, you want to remove that LMI. Because you have built sufficient equity in your either asset or portfolio.
It comes back to investing to invest, not just to say you're an investor, but to buy a good asset.
Well, you're doing it for a purpose, right? Don't just do it for the sake of it.
Yeah.
Do it for a purpose,
That's right.
And do it under really good advice. For the verdict, Sam, for LMI versus a 20% deposit is?
LMI, just pay it. Just pay it. Do it, get it done, get in the market, get a good asset, move on.
Unless you have sufficient funds, where most people don't,
Yes.
right?
Yeah.
So, I still use LMI,
Yeah.
where I can, if the banks are willing to give it to me. Number 4. This is a massive one. This is a massive one for our wannabe property
Developers
flippers.
Flippers, it's very, we like to say it's very glamorous, don't we, in this space, because people can see the golden nugget at the end of that deal, a lot of cash, a lot of money. And what a lot of people don't realize is there's consequences to realizing that profit. In what we talk about with clients, we're always about buying one property and making sure that property has the fundamentals for you to hold it forever and keep paying you capital growth. So we're not really in the market of flipping. And one of the reasons why, from a tax point of view, which I deal with a lot with clients, is exiting a property, especially if you're flipping, has a lot of expenses attached to it. So along with your commissions and advertising to sell the actual property, what people don't realize is that if you do a flip, for example, 10% more or less of that is a GST that you have to pay to the ATO. 10% of your profit goes to the ATO. On top of that, you'll have to pay about 30% profit, tax on the profit. It's not a capital gain, so you're not getting a discount. You're going to be hit with a lot of taxes. So while it sounds, good to cash in, maybe sometimes it's not so much effective.
So I must apologise to our listeners because we've just jumped into that and just bagged the shit out of flippers where we didn't even state what the battle was. We didn't announce the fighters, right? So it's either sell or refinance.
Refinance.
Right? Sell or refinance. And, you must excuse my excited co-host for really jumping in and being very passionate about being against flippers. But we are.
I'm coming from a tax background. And when I see people that want to flip a property, I'm like, just realize you're going to pay a lot of money. You probably want to hold it, tap into equity, refinance, and do something with the money. So I guess I got carried away with saying don't do it because I see people paying a lot of money.
And we're very passionate about it because I've actually made the mistake of selling when I shouldn't have. Uh-huh. And by the time I paid, the tax and the marketing fees and the real estate agents, and essentially I ended up with cash, which really is a liability at the moment. Yep. Right now we've moved from cash being an asset to cash now being a liability. We need to now put it back into the marketplace. So generally speaking, when people sell or flip properties and they generate a profit, and so look, sometimes people have to do it because they just can't refinance. They don't service and all of that sort of thing. But let's say, they sell it and they make $200,000 in profit, and then after costs, they've got 120 grand in the bank, right? Now, that 120 grand, what do people generally go and do?
Reinvest it.
They buy more property.
But you have to pay stamps again.
Yeah. So you're paying a new set of entry costs, and then they'll keep on going and going and going. So the buy and hold strategy is a beautiful strategy because what happens is you refinance, right? So that property goes up in value. Go back to the bank, refinance it. You could even get a better rate, better package, and then get that new formed equity. Use that new formed equity tax free because essentially it's debt, and then put it into the next property. And then what happens is that not only do you have another property, but you still hold an asset that's cash flowing. Now, what I love about that is that the real wealth is built in the buy and hold, right?
Yes.
Yes, you can get rich from flipping properties, but you end up with a liability, which is cash. We want more assets.
I think, and just touching on that to finish it off, if you're going to flip or develop, maybe not develop, but develop something and hold it, make sure what you're developing or building is going to be in a good location and tick all those fundamentals, because the last thing you want is to try and manufacture this equity that's going to be stuck at that 150k increase and not going to grow because you haven't picked the right spot. So we've had clients sort of think about developing something in a less or maybe an inferior space just to get a capital growth, maybe flip it and realize that gain, but if they're to hold it, it's probably not the best space to hold it in.
So the exit strategy is really important. Like, for example, if you're a flipper, I guess the benefit is you don't really need to worry about the location and all of that sort of thing because, you know what, like, you're going to get rid of it anyway. So if it's buy and hold, then you're going to make sure that we want to buy and hold forever. Yep. So there's probably you really need to know your final exit strategy because you don't want to get into a flipping strategy and just go anywhere and then all of a sudden you've gone, oh, hang on, I'm going to buy and hold and refinance, but you're in a shit location, right? And a lot of people get stuck in that because what happens is they go into an area and they find a bargain, and it's a bargain for a reason because it's in a shit house area, and they buy it, do it up or develop on it, and then realize that, okay, well, maybe the market's cool. They can't sell it, right? And they go, oh, it doesn't matter, we'll just hold it. But now they're holding on to a bad asset. Yep. So what you really need to know is, okay, what's your strategy? What's your exit, right? And then go back to the beginning and go, let's work it according to that. So the verdict for that, obviously, is refinance.
Refinance, lower cost, better in the long run. Keep as much cash as you can. Keep growing. Easy.
Beautiful. Number 5.
Oh, it's a common one we get a lot. Residential or commercial?
I actually have not met a commercial real estate agent that I trust.
Wow.
I just feel like they're all snakes.
Really?
Yeah.
What, they're very like
Look, in saying
salesmen?
that, I haven't dealt with a lot of them, right? But they just have no human connection. They're all just about numbers, right? And look, as much as we are about numbers in residential, the problem that we have with commercial real estate is that you actually need really deep pockets. And that's one thing. Like, I've done commercial before, so I've done very well out of it.
Yep.
But it is capital intensive.
What's the loan to value ratio, generally speaking, in a
Generally,
commercial?
it's 65 to 70%, meaning that you need to put a 30 to 35% deposit down. So a $1 million property, you're going to need about 400 grand.
A lot of
right?
money, yeah.
That's if you want to add in your stamp duty and all of that sort of thing. So banks generally deem them as a little bit more risky, but with the risk comes the reward.
Yes.
You get the better yields, you get the better returns. However, I've never really sort of gotten too far into it, because I just feel that if you have a vacancy, you can have a vacancy for a very long time.
It'll hurt because you're relying.
Especially now through COVID.
And you're relying on that big yield to help service that bigger debt as well. So it's I haven't seen too many clients go into the commercial space. A lot of the clients we deal with would maybe buy their business premises and rent it off themselves in a tax-effective manner, usually in super. So there might be scope for some certain people to go into commercial. I don't think it's generally a common thing to do. What some people, just from a tax, I always come through with a tax point, just to try and
flex your muscles.
Flex some muscles. Well, what people don't or may forget is that if you have a commercial property that generates an income over 75k, so you might have to have a pretty good property. So if we're talking 8% yield in some commercial properties, so if you get $1 million property in commercial, you're going to be renting it for about 80 grand a year. Once you exceed 75k, you're liable for GST. You have to register for GST.
Wow.
Right? So because it's commercial, residential property, regardless how many you have, you could have $10 million worth, generate $1 million, whatever it is in rental income, or 800, whatever it is going to be, exceeding 75, you don't have to register for GST. You don't have to pay 10% of your net profit to the ATO. If you're dealing with business premises, you do. So from that point of view, in the tax space, watch out GST in commercial properties. It's something you'll have to pay to the ATO. And look at COVID, another aspect. What's happening with businesses now?
They're all vacating.
There's empty premises everywhere. So who knows what the future holds with businesses? Everything's going digital. It might be a space that, I've even heard in North Sydney, some of those commercial buildings, they're trying to convert to residential.
Oh, wow.
So it's showing that the sort of risk involved in commercial. Residential, everyone needs a house. You say it all the time.
Yeah.
People live in homes. Everyone needs a home. So there's always demand.
And let's just, going off your point on the GST component of the commercial properties, and a lot of people will argue, but you make big money on commercial, like you make a lot of money.
Yeah.
Which is true, right? It is true. And that's the reason why. There are added costs. Like, you deserve to make more money because, it's not just GST, your interest rate's higher, right? Generally speaking, your interest rate right now for a residential property is around 2%. Like, for commercial, it's double that, if not more.
5-6%.
Right? Also, you've got, with commercial, you've got a shorter loan term. So you've got 30 years with residential, right? Which means your repayments are a lot less, right? Than, say, 15 years. And that's with commercial, you don't do 30-year loans, you do 15-year loans. So everything's all relative, right? It costs more money. Yes, you can make more money, but it does hit you relatively. And the problem is if you have a vacancy, you've got to ask yourself, can you wear that vacancy? So, for example, that property you said that's yielding 8%, so it's bringing in 80 grand a year, and then all of a sudden it's vacant for 6 months. Can you wear $40,000 of no rental income coming through?
Yeah.
A lot of people can't. But with residential, you've got vacancy rates at sub 1% at the moment. And everybody's got to live in houses. There's a housing shortage. Sure, you don't make as much money as in commercial, but it's less risk. Now, let's also talk about lending. What do banks love the most?
Residential.
They'll lend you up to 95% in some cases for a residential property. They will not do that in commercial. I was just looking at a commercial asset that was worth a couple of million, and I was thinking about buying it. And I went to the bank and I said, look, I'm thinking about buying this commercial property. What LVR would you be able to give me? Because I was trying to get the highest LVR possible. And they said 55%. And I was like, 55%? That's like half. That's $1 million.
Wow.
And they said because of COVID and the state of the commercial property market and how many vacancies are on the market and all of that sort of thing, they said it doesn't matter if you're fully tenanted, we're only going to give you 55%. And I was just like, wow. And then I said, okay, what about a residential property? And they were like, well...
Everything, 100%. Here you go.
Mate, well, let's have a look at your portfolio and we'll just fund the whole thing, basically 100%. So, like lending, you can sort of leverage a little bit further with it. And I think leave it for the big boys, that commercial stuff, because if anything was to go wrong, I think it'll really, really hurt.
Banks know their stuff. They have researchers. They know shit. There's a reason they're only going to give you 55%. There's a risk involved. They don't want to be exposed too much there. So, and I think going back to what are we talking about? Growing your future. It'd be very hard to grow with a commercial property. Commercial property, like you just said then, it's for the bigger boys. If you have millions of dollars and you're trying to find a place for a good return, do it. But you're trying to grow and build your capital to 5-10 million, commercial property is not going to do it for you.
I had a guy the other day goes, oh, you should just do commercial. Just, I don't even know why you bother with residential. Go do commercial, right? And I'm like, yeah, but you're worth like 30 million, right? Like I'm not.
Different space.
You know what I mean? I'm not worth 30 million, 40 million, right? Like I'm still growing. So, and most of our listeners and our clients are still growing as well. And residential is how many people, many successful people start building their wealth, and then they venture off into other things. It could be property development, could be commercial, all of that stuff. So the verdict.
Verdict, residential.
Residential.
100%.
Residential. Number 6 is an interesting one, especially now.
CBDs or regional?
CBDs versus regional, Sam.
So we've seen since COVID, a sort of shift in that dynamic. A lot of people would tend to associate CBDs with a lot of growth and maybe a better place to put money. When you're seeing now a lot of people running to the country areas or the less built up areas to have more space. So that dynamic is sort of very fluid at the moment. And who knows what's going to happen after COVID is behind us and what's going to happen in terms of demands in these areas. I think what people have to realise is CBDs and regionals, they're two very general topics or segments. They both have different segments which could perform or underperform.
Let's give our listeners a little bit of an example of what we're talking about, because we've got some beginners that listen to us. What's an example of a CBD?
A CBD is like, say, Brisbane.
Yep.
In Brisbane, there'd be suburbs within Brisbane, close to the CBD, within, say, kilometre range, a couple of Ks.
Yeah, you could say 15, 20 Ks.
15, 20 Ks. Then you'd have suburbs like 30 Ks, 40 Ks, even further, probably, and just further away from a CBD. Even, say, Sydney is a CBD and Central Coast could be deemed regional.
Yeah, great.
So it's just further out
Yep.
than that central business district of that area.
So I guess going back maybe 2 or 3 years ago, CBDs were looked at as the premium,
Holy grail,
the holy grail of locations. For example, we focus on Melbourne, Sydney, Brisbane.
Yep.
Now, secondary markets, as in regional markets like Central Coast, Newcastle, like Bendigo down in Melbourne,
Cairns,
and,
up there.
Yeah, so like these regions are now going off, right? Because people are really starting to value their space. I'm not going to go into houses versus apartments because we've actually got that
that's
later
a topic
on.
later.
That's another fight that we've got to deal with. But CBDs I think still offer really good value. We've been doing a bit of research on this, Sam, regarding, is the move to the regions a bit of a sugar hit?
Yeah.
I think it's great because I hold a lot of property in those regions, but not just that. I think it's great for those regions to start getting some really good growth. I think the property owners in those regions are really starting to, take advantage of having that growth and reinvest into more properties or into their existing properties now. So it's a good sign. I think it's about time they had their time in the sun. But eventually, when this whole work from home thing, starts to ease off, and the infrastructure in Sydney is where everybody really wants to be close to, and I think people will travel back to the CBDs. Now, what's right or wrong? Because this is a fight. You know what I mean? Someone's got to win, and the thing is with regionals. Regional markets offer affordability. Yep. Traditionally speaking, I know now it's becoming quite unaffordable, but in comparison to CBDs, regional markets are actually quite strong. There are blue chip areas within these regional markets that we should focus on, especially if we don't have the money to get into those CBD markets. So, for example, a lot of people can't afford $1.2 million to buy a house in Sydney, but they can afford to buy a $600,000-$700,000 home on the Central Coast, right? So it's a good starting point. It's where I started. I'm still building an incredible amount of wealth in those secondary markets, but now I've upgraded to the CBDs because eventually 10, 20, 30 years down the track, I want to be proud that I have properties in Melbourne, properties in Sydney, and properties in Brisbane. You should always upgrade to the CBD markets. Now, in saying that, who wins?
I don't think you can call it.
It's a draw.
So CBDs, you'd have good assets, bad assets. Regional areas, you'd have good assets, bad assets. They're both composing of the same thing. So I guess it really comes back down to picking the right asset. That's essentially
for the individual.
For the individual. So if you take a regional, just to quickly touch, if you take a regional area, I had a client invest 200 grand into Cairns 20 years ago. And I think you've invested into Central Coast probably, 15 years ago or so?
About 12 years ago, yeah.
And you did quite well on that investment. Killed it. This client invested in Cairns, another regional area. So Central Coast, Cairns, probably not equivalent, but regional areas. The Cairns probably didn't move for 20 years. So it's just a waste of time. So not saying anything bad about regional areas, but if you pick them right, you can make money. So if you're comparing them to CBDs, they're both on par.
And a quick tip, I think, with the regionals, because a lot of our listeners will flock to the regionals because of the affordability factor, right? And they make great first investments, and many of my clients have made them. I think a big tip with regional is the proximity to a CBD. So if you're an hour or two away from a CBD, that's probably going to be a great regional market, as long as it has multiple economic drivers, so it's not just like a mining town or anything like that. But it also has that proximity to the CBD, to a CBD, so that people can commute. And this is the reason why regional markets are going off now with this whole working from home thing, is that they can go to the office one day a week or once a fortnight, and then they can work from home the rest of the week. Now, the commute's not that bad when it's one day a week. They actually look forward to it because they get to go and socialise. The commute to work, say 1.5 hours, isn't really that bad. Like, I spent 2 hours on the road yesterday, but it wasn't that bad because I'm not always on the road, all the time, right? Yeah. And I was actually looking forward to it. I got to a different area. I got to meet different people. It was nice to get out of the eastern suburbs of Sydney, right? So I think a lot of people are starting to look at a commute as not really a commute anymore. It's just really just traveling.
It's like an adventure now.
Yeah. They make a day of it. It's an excursion.
That's right. It's different. It's mixing up your week. So what's the verdict?
The verdict is a draw. The verdict is a draw, so they're both good. They're both good. Okay. I actually don't like draws. I like it when we get to shit on something, right?
I'm sure
I like it when we get to like kick something when they're down.
Could be the next one, maybe.
Yeah, well, it could be new or existing.
We've talked about these types of things many a time. I think when you're getting into the market, really, and you're starting out, which is what we're doing with most clients, getting their first, maybe second property, you really have to weigh up new and existing stock in a number of ways, different components, different costs. With a new property, you're looking at something that is obviously brand new. You don't have to do too much to it over time. You can hold that property for 10 years and not have to spend too much money on it. Buying brand new would also give you certain other tax advantages that an existing property might not. So lots of different components to the two. In your opinion, what would you say?
Look, a lot of people start off with established, right? Because it's affordable. It's usually in their own neighbourhood. They're familiar with it. But what I've learnt over time is that established properties don't yield as much because they're older, they require a little bit more maintenance, they're not as desirable, but usually they're well located because usually the more established stuff is in the better locations.
Yep.
But it's hard to get right because people they misjudge the maintenance costs.
Yep.
That they require a lot of capital to keep running, especially if you're getting a low yield and you're also having to tip in for repairs and maintenance and all of that sort of thing. It really eats away at your bottom line, and people don't think about that. Like, if you've got to install a new $3,000 air conditioner, like that's quite a lot off your overall yield for that year. That's just a small example, and I've been through it where I've had to upgrade bathrooms, upgrade kitchens, and it becomes very laborious. I think it's a great way of getting into the market, into a good location, if that's all you can do. But generally speaking, newer properties as investments, I think they provide a better, well, no, I don't think, I know they provide a higher yield, better tax breaks, and lower maintenance costs. And it's just a set and forget. So your cash flow position is really supported. Now, established properties, I don't want to bag them out too much because I've got a lot of established properties in my portfolio. But what I would recommend to our listeners that established properties work really well if it's going to be your principal place of residence. Why? You can get the really good locations. You're not relying on a yield, right? Because you're going to live in there yourself. You're not getting a rent.
Yep.
You can add value through renovations, and the maintenance isn't going to be really that laborious because you're actually living in it, right? Like it's yours.
And you're tailoring it to what you want as well.
Exactly right. You can customize it, but that's an emotional decision. We're talking about investing now, right? And we want to be able to have a low maintenance investment that's not going to provide us headaches, so we can just keep buying and buying and buying.
The brand new property is going to be very attractive to a tenant. So if a tenant has two choices, an older dwelling or a newer dwelling, they're going to choose the new one. So you'll be appealing to more clients, potential tenants. Tax-wise, like you touched on, depreciation benefits are much more evident in a brand new dwelling. So that's going to help you with your cash flow of holding this property. Another thing you touched on was the maintenance costs. And I had one specific case with a client. You've heard of special levies as part of strata plans. This client has actually a really good investment in DY. I can't remember how much they paid. They've made equity. They made growth on it. They have some equity. But the property was, I think it's one of about 8 or 10. And what's occurred, I think it's about 20, 30 years old. There's structural issues in that complex now. And it's going to cost them about $800 to $1 million to repair. Wow. The special levy is going to be about $100,000 each.
Wow. So some people are going to be forced to sell.
The guys are asking me, what can we do? They're fortunate enough to have other property. So this was one of their first purchases that they made. So they do have equity to try and hold it. But now we're going through the motions of, do we want to hold it?
Yep.
Is it going to be is that capital we're going to inject? Is there going to be a return on that over time? Should we do something else with the money? So another thing about older properties that some people might not think about is if you're in a complex or something with multiple dwellings in that area, some special levies might come your way down the track, which can hurt a lot.
And to counteract that, we get a strata report.
Yes.
Right? So we can really get a professional to analyse through that report to make sure that, you're not walking into something that's going to be...
To burn you, yeah.
Yeah, a money pit. So the verdict on that is new.
Yeah.
Right?
100%.
Moving on to number 8. We're going to fly through these, Sam. Owning versus renting. I think a lot of people will know what my view is on this.
The old pickle. Owning, okay, we're talking about growing your future and investing. Owning a property is going to take up too much money. We know just by looking at mortgages, how much you have to pay, paying down principal, it's going to hurt your ability to use that money elsewhere. As opposed to renting, you don't have to put so much capital. There's no down payment, there's no deposit. You can use that to buy another property, and then you're not having to pay, say, a larger mortgage, and your cash flow is a lot easier to save capital for the next investment.
Can we also talk about when you rent, you can rent where you actually want to live. Like, I know so many people that are so hard up on trying to get a place that buy a place that they can live in, but they live 60, 70 kilometers away from their place of work or where their life actually is.
Yep.
And they do that because they just want a property that they've bought themselves. I think that's a very inefficient use of your time and your money.
Yep.
And I think what you should be doing is just rent where you live, because it doesn't cost that much to rent, and deploy your capital elsewhere where you're going to get a better return.
Where you live and where you put your money is different. We talk about it a lot. So if you're in a position or want to buy a home, cool. But if you want to invest, grow your future, putting your money into areas, not your home, and in areas that are going to grow is the best thing to do.
That's actually one of the biggest debates, right? One of the biggest battles that people have, and including myself. Like, sometimes I think, oh wow, I should just buy a place to live in. But really, if you want to grow and you want to make money, you want to build wealth, then yeah, invest, right?
Having your home also is going to affect your servicing.
Yeah.
I look at it like you got a mortgage, you can't afford to invest.
Slows you down.
Right?
It slows you down.
So it's going to slow you down.
So the verdict on that is obviously rent, right?
100%.
And if you have to buy something that is going to be an investment one day, so you can go and rent that out.
100%. Next one. What is it?
Apartment versus house.
Ooh, we deal with this a lot in our consultations with clients, right? Going through the pros and cons of each. Obviously very different characteristics of the two. What do you think the most key differences are between the two?
Well, obviously, the big debate is, and a lot of people, I think they lean towards houses, right? Because right now houses have got a great run. It's that land component. It's usually the holy grail of capital growth.
Yep.
Because they're not making any more land,
scarce,
right?
yep.
So we can build up, but we can't really build out. But the thing is, apartments generally offer a better yield, a better cash flow position, and they offer a really good alternative to a house or a townhouse throughout a property portfolio as an investment. Now, the interesting thing is that apartments have been copping a lot of flack because of this whole COVID thing. No one wants to live on top of each other. So apartments haven't really seen much growth lately, which to me proves that it's a great market to buy in, because eventually the apartment market will always catch up to houses. So houses are having a bull run, like they are just going nuts. Anyone that has a decent sized block of dirt with a dwelling on it, they can command whatever money they want. Where I see the opportunity now is in apartments. So me right now, in the next 12 months, I'm going to buy like 3 or 4 apartments, because I just know that I can buy at a really, really good discount. And I know when, things normalize and go back to normal, and also people can't afford to live in houses in certain areas, they're going to flock to apartments. So for example, you try and buy a house in Bondi, it's going to be $3 or $4 million plus, right? Now, you can still get an apartment in Bondi for $1 million.
Yep.
Now, I think that's extremely good value, because there's people in Bondi who want to live in Bondi. They love the lifestyle. They love the area. They love the proximity to the CBD, but they can't afford a home. The next best thing is an apartment. Now, apartments right now are at an all-time low. So if you can get in now, and then ride that wave when it starts to really pick up and catch up, I think that's going to make a great investment now. It's just really hard to convince people that that's what's going to happen.
When do you think it might pick up? I'm just thinking off the top of my head. when immigration starts occurring a lot more and there's more a flood of overseas people coming, more or less to CBDs, do you think a lot of demand will start occurring for those apartments and things?
Well, a lot of these people that come from overseas, like particular Asians, right, and even Europeans, when they come here, they're used to living in apartments. They don't come here going, "Oh, the great Australian dream, I want a massive 5-bedroom mansion." They're happy with a 2-bedroom, 60, 70 square meter apartment.
They want the convenience.
So once those immigration starts coming back in, mate, they're going to flood into that apartment market, and there's a lack. There will be a lack of stock, and that's where I find, okay, buy it now where the demand is actually quite low, and then once those the floodgates open up, I think the prices are just going to go through the roof. But look, we've just given apartments a great rap, which a lot of people will probably thinking, oh, houses are the way to go. Look, houses are great. They offer really good capital growth. We get a lot of our clients into houses. I've built the majority of my wealth from housing. They do a different thing, right? You can't, it's like comparing an apple to an orange. They're both really nice fruits to eat, but they're different. Right, they're different in colour. They give you a different nutrient content, and it's the same with property. There's no right or wrong. So the verdict for that is a draw.
It's a draw.
It's a draw.
They both have their purpose. Investing 101, diversify. So if you're going to go into the share market, you're not going to put all your money into tech stocks. You're going to mix it up. So the same with property. You're not going to buy all house and land. You're going to apartments, townhouses, and mix it up. So they're exposed differently.
And that's what's part of the 10-year acquisition plan. People think, oh, it's got to all be houses, or it's got to be all townhouses. No, it's a mix. Yep. And it depends on your individual situation. So
Correct.
It's a draw.
Draw.
Moving on. Increase debt or reduce debt?
Oh, okay, let's define debt first, or categorize it. We've talked about it before, good debt and bad debt. So it would depend what debt you're reducing or increasing. So bad debt is something where you're taking out a loan to put towards something that may depreciate in value. A good debt is something you take finance out on for a productive asset, something that's going to go up in value or provide a yield. So we have to identify the two, and basically you want to increase a good debt if you can and minimize a bad debt if you can.
So increase productive debt, like, buying apartments, townhouses, houses that produce an income. Decrease bad debt, like car loans, credit cards,
personal debts,
all of that sort of stuff, right? So really, the verdict on that is a draw. Because you want to increase the good debt, decrease the bad debt.
Different sides of the ledger. Different sides of the ledger. Yep.
All right. So the last one is the most exciting one, and it's Zah versus Sam.
Who came up with this verdict? I think that was a bit biased.
Mate, we actually asked 10,000 of our podcast listeners on who they voted for, and they actually voted for me to win.
The eggplant.
It's because you're so focused on saving tax, and I'm focused on growing income.
I'd agree. I think we're both needed. You're needed to grow, and I'm there to help minimize any costs along the way. So I think you need that growth first, and then I'm there to try and help minimize anything along the way.
Sam, you've convinced me. It's a draw.
It's a draw.
I
had to switch it up a bit. We're both needed at different points in time.
Sam, thank you for taking part in the Rumble in the Jungle. I really enjoyed this one. And for our listeners, I hope you enjoyed it too. It was a long, drawn-out one. We got Lindsay there. He's dying behind the camera. He wants to go home. Guys, thanks a lot for listening. Thank you, Sam, for contributing. We really enjoyed bringing this to you. Until next time, we'll see you later. Peace.
See you guys.